From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Good afternoon, this is the COB, all the stuff you need to know about markets and business in the past, 8 hours or so. I'm Kyle Rodder with Danny Akuye. Danny, well, it's a
down day.
It's a down day. A dull down day, I feel.
Oh, well, we had to eventually have sell in May and, whatever, have a snooze. But, interesting. Information technology, from what I can see, still rocking and rolling up about 1% today. And the complete antithesis of the likes of the financials. What else is down? Materials sector. Yeah, so very much, I suppose, anti-cyclical, one might say.
Yeah, definitely. And I suppose there were those concerns emerging last night in the United States, perhaps about retail there. And that takes us to the three themes. And the first one, I said rankled by retail because we had those weak retail figures out of, the official data in the States, but also those Home Depot numbers weren't particularly strong. I know that you get up pretty early, you watch the US market close. I know they reported before the open, of course, but this sort of sense that maybe there are some clouds on the horizon.
Well, the housing sector's, clearly not in a good state over there. No one's actually moving houses, no one's renovating anymore. And I think it was the first fall in sales revenue since 2009. So saying very much that the consumer has put their hands in their wallet when it comes to their homes. And that's, there's underbuilding, as we discussed yesterday with a guest. But so clearly the consumer is being very, I suppose, specific about where they spend their money at the moment, and probably travel and going out is capturing a lot of it. But obviously stocks like Wesfarmers probably were hit quite heavily on the back of that Home Depot, because it's kind of the Bunnings comparison for some investors. Yeah,
a bit of a like for like there. And I suppose for the macroeconomic news today, we did get that wages numbers, wages data. Didn't seem to shift the dial too much. A little bit of a blip on the Aussie. The ASX 300 basically shrugged it off. I didn't see a huge move in rates markets by any means.
Aussie dollar's a little bit weaker this afternoon by almost 0.3%.
Bit soft, fairly choppy though. So they came in at 3.7%. Of course, the expectation was for 3.8%. Again, didn't seem to shift the dial too much when it comes to rate expectations, especially for next month. But last but not least, I got in there, get it done, and that's of course referring to the debt ceiling. And did you hear President Biden's not going to be dropping by our shores anymore?
Yes, he's got bigger fish to fry, so to speak.
It was apparently, I mean, maybe tuna fish or a sashimi or something like that, because he's going to Japan.
Going to Japan and then heading straight back home. Who would be the president that presides over a US default?
Yeah, you don't want to be that guy, do you?
No, it's not great for your re-election, is it?
No, certainly not. But let's go across some of those sectors very quickly that we wanted to have a look at, starting off with tech, because you did say, Danny, that it was one of the better performers for the session. Actually, Xero up 2%. That's an interesting one.
They're reporting tomorrow, I think.
So
maybe some positioning in the run-up, because we have had some great results today. I spoke with the Serco CEO, and that stock is up about, last time I checked, 31%.
Interesting.
So maybe they're sort of thinking, the Aussie/New Zealand companies are going to get the runs on the board.
Yeah, exactly. Utilities, let's have a look there as well. A little bit more mixed. AGL up by 1.86%. Mercury New Zealand, I don't know if that's anything to do with the fact that they've obviously got some disruptions over there. I really don't know, but down by 2.2%. But let's get to the top stories of the day. United Malt Group released results. I don't know if you had a chance to gaze at those at all.
No, I've been a bit busy.
No, Incitec Pivot as well released earnings. And here we go, you can see the price reactions there. So that tells a lot of the story. United Malt Group, I think it actually cut its dividend. We're going to talk about Mark Gardner, who is Mark Gardner, who is our guest in just a moment, but cut its dividend, I do believe, and maybe the devil's in the detail there when it comes to why the stock's up. Incitec Pivot clearly down 8%, as you can see there, and Best and List, I guess raising concerns about household budgets just a little bit, the demand outlook from here. But let's stay on Incitec Pivot. Of course, it was our stock of the day, and Henry Jennings and Andrew Weiland gave their view on the stock.
I guess, the market at the moment does seem to be hunting for bad news. This one was a little bit of a miss. It missed by around 6% in terms of their net profit, which obviously they're being punished for. 8% down at the moment. So punished today. I suspect it'll get punished in the next few days, although the fall will be less so. Then it will find a bit of a level. So from there, it's probably a hold, but give it a little time to wash through with these results.
I think that I'll take the role of the grumpy old man here and just say this has just been a perennial underperformer. And if you look over even 5 years, it's been just underwhelming. Talk of a second half turnaround. I hope they do it, and certainly for long-suffering shareholders they do, but I would be incredibly surprised. It is at best a hold, and frankly, being cranky, it's a sell.
I like that new definition of a sell, a cranky sell, perhaps.
You've had enough.
You've had enough. You have a cranky sell of a stock.
Long-suffering shareholder. You're just going to throw it in the bin.
Okay, well, let's get to Mark Gardner from Macro Capital. He's at the desk. Perhaps we can start by having a conversation about Incitec Pivot, of course, and welcome along. I mean, do you have a view on the stock in particular? By the sounds of things, according to Andrew Whelan there, that's a perennial underperformer.
Yeah, look, I mean, it massively missed analyst expectations, but realistically, if you have a look at it outside of that, I mean, profits were down, well, I mean, most metrics were down sort of 6 to 8%. Explosive business did well, which made up for the fertiliser business. Fertiliser prices in the US have been pretty much hammered. On the back of the fact that their larger crop growing areas are just still in really bad drought. So, you're not going to have volumes of fertiliser being bought up when people aren't growing crops. So, but look, it's diversified to the point where, that really made up for it overall. I think it's a bit of a similar situation with Elders as well. That both of them said that, earnings were probably going to be stacked to the second half of the year. Analysts have really, essentially, on a full year basis, both those companies are around about, correct on the analyst expectation. It's just the timing that the analysts have got wrong, and the stock's been punished. Both stocks have been punished on the back of it. But look, if you see the forest through the trees on these two, consumer staples is the second best performing sector when US hits recession. Both those companies are in single digit PEs, and look at these prices at the moment. You're getting it like anywhere from a 3.5% to 4% dividend, from between 30 to 60% franking, depending on which company, for 6 months. So, I mean, if you're looking forward to the next 6 months, with knowing that both companies have said with the earnings being stacked to the second half, I think they're looking great value down here. I mean, you're going to have obviously a sector. US recession is pretty much on the cards. So, but if we go back in history, statistically, you're going to be involved in a sector at a very cheap, multiple, and receiving a dividend in the meantime as well. If things go well, I mean, you may end up looking at when these guys report in November, getting a yield more around the 9% mark overall. So we all need food. The world's overpopulated. So. And if we start to see a reversal of that La Nina El Nino, well, IPL particularly is going to have a big uplift in people buying fertiliser. So they will here on the eastern seaboard as well, and that's what both Elders, Grain Corp, and IPL have all said that. So yeah, I think there's some bargains there, but I understand what they're saying. The cranky sell, Elders shareholders. I mean, we've had it for 18 months. It's bad sentiment. It sort of reminds me a little bit of, look, James Hardie last year was one of the worst, if not the worst performing stock on the ASX. Here we are in the middle of May, and all of a sudden we've bounced from $28 to $37, and it's just the market just gets it. Market and the analysts just get it wrong for a period of time on their timing. They either get a little bit ahead of themselves, is more often the case. So I think you probably just wait. At these levels, get paid that dividend in the meantime. I think Elders and IPL divvies are basically over the next week and a half. Grain Corp's a different story. The dividend's not for a couple of months, and it did have a decent sized run up. But look, it's decent value in the right sectors, given what's probably going to unfold in the second half of the year. So yeah, it's not enjoyable watching them go down. And I think a few people are getting frustrated and flushed out of the positions. But if you look at it on a 12-month basis, it's a super high percentage trade buying any one of those stocks.
It's amazing. I'm just having a look at Elders. I mean, it was at $15 and today it's closed down another 3%. And according to a certain website, they're on forget this year's yield because we're halfway through. Unless, was that the first half result for Elders? Or?
I believe so,
yeah. So that's about a 7% this year and 6.4% next year, and single digit multiple. At some point, once the momentum turns...
More than the bad sentiment.
Yeah, the sentiment, because a lot of people, as you say, just get disillusioned and throw out the towel at the bottom of the market, maybe.
EBIT's down 15% for that stock. The stock's down over 50%. I mean, it's just an overreaction, but sometimes it's just... if you've got the fundamentals on your side, sometimes it's just better just to bury your head in the sand and wait for the next earnings result, and at least you're getting a dividend in the meantime.
Yeah. What about United Malt Group? Yes. Again, I just sort of took a very cursory look at the notes that we had on it. Did it scrap its dividends? I mean, what was the story there in terms of...
I think that probably for this result, as long as they didn't screw it up, given that there's an offer on the table, I think that's probably where the positive sentiment's coming from a little bit. So obviously if they had a poor result, that may have put that takeover bid in doubt. So I think it's a bit of a different scenario maybe for that one. I sort of flicked through they talked about how craft beer was down because obviously it's much more labour intensive. They can't get people to make it. But they saw an increase in Pilsner and Lager, which is an easier beer to make, start to kick up, which apparently they've got slightly higher margins on. So I'm not a beer connoisseur, but I think, with a takeover bid on the table, not screwing it up was probably the main point, and that pretty much sort of clears the path for that transaction to go through. They just didn't want any skeletons, to appear from the closet, I'd say.
Sounds like the hipsters are tightening the purse strings perhaps in the craft beer or something. I don't know what the coffee prices are doing. But now we've got a couple of stocks that we wanted to bring to the table just in terms of discussions. Smaller cap names, if I'm not mistaken. We've got to say it's been a sort of a relatively quiet couple of weeks just in general, but Ventia, is that am I pronouncing that correctly?
Ventia Services?
Yeah, Services Group. Yeah, something that's caught your eye?
Oh, look, it's just two, basically I've got two sort of non-cyclical names really, leading into recession that seem quite cheap. Jumbo Interactive's the other one, but Ventia's, it's relatively new from a listing point of view, but it's been around for a long time, but has all those great characteristics, nearly a 6% yield, PE's just shy of the teens. Super sticky customers with nearly 80% from government contracts, 4 different revenue streams. They do a lot of infrastructure maintenance, essentially, which you basically can't go without. So it seems to me they've got $18 billion worth of work in the pipeline as well, and given they've just got a really solid track record. So that's more just. With debt ceiling things going on, US economic numbers softening, then surprise softening in numbers in China as well, which are all going to affect the global economy. Just sort of hunting around for something that's a little bit non-cyclical, that yields, it's not going to give you too much trouble and too much stress. Jumbo Interactive was another one. They had a really positive response after the Macquarie conference. And they essentially they've expanded into the UK with an acquisition. Again, they've got it's about a 3% yield. The PE's fairly reasonable compared to sort of the Lottery Corp, and they've got sort of increasing different revenue streams. They're sort of offering software as a service to other providers now, which they were sort of white labelling as well. So and lottery numbers always, for whatever reason, tend to do much better in recessionary times. They're very immune. In fact, sometimes, quite often, will head up. So that's just one that, from a, particularly in comparison to TLC, which is sort of considered a fairly safe stock, seems to be actually quite a bit cheaper because TLC is really restricted to Australia, where these guys are now branching out in the UK and the US. So they're sort of more justifying that, PE north of 20. So yeah, it was more digging around for what's to come rather than, I get a little bit sick of reading lithium articles and things today. Everyone's got a new opinion, which usually means there's a top or a bottom just about to be put in place. It's just sort of digging around for stocks that might insulate the portfolio going forward.
Yeah, no, it's a really good idea, because we've seen, even though the index isn't, been going, anywhere really, and we've seen the mining sector under pressure, the materials and the banks, but yet some stocks have been shooting the lights out. So the market is differentiating, isn't it, between the haves and the have-nots? It's
fairly random too, in some cases. So it really is difficult to, when it's this noisy, it's sort of better to, I think, just step back. Like in the case of the ag sector at the moment, it's undoubtedly under pressure. Not much fun to watch, but you've sort of got to keep a level head and go, well, put yourself into a good position to make some money going forward, because you don't really want to be buying, in the event that there is a recession or we have a US default or something like that. Buying tech up here at these levels. I was looking at the Apple, Google, Amazon, and Microsoft last night. We're at 18-month highs in PE for all of those stocks, and it's whilst there is a bit of a bid tone, they and whenever they sell off, they just drop the AI word and seem to rally back again. But there's really significant downside risk, really. I mean, they may stay up here, and the next round of quarterly updates may justify that, but if you sort of chart PE underneath the share price, which is something I do quite often, whenever it gets up to these levels in all of those stocks, there's usually a correction at some stage, and it doesn't have to be a disastrous correction, but they are trading very expensive. The most expensive levels they've traded in around 15 to 18 months in all of those stocks. So it's just something to be wary of. And it's a similar situation. CBA at the start of the year was trading at 20. Yeah. It quite often gets to 20, and the share price will fall back. It's a nice little way to see where things are in terms of cheap and expensive in the range overall.
I'm just trying to find the stat that I read over the weekend. You might have heard it as well. It's that if it weren't for the AI-associated stocks, the S&P 500 would be down by a couple of percent.
Yeah, down 2%, and so it's a 10% difference. So overall, and look, and Google itself. I mean, Google's behind the 8 ball with the AI stuff, and at risk of losing the Chrome browser. But Samsung's looking at moving to Bing, which is. No one ever thought they would say that sentence. So Microsoft's always been kind of the plodding dinosaur in this area, and they rolled out a new phone, which was nearly $2,000. Like, who's buying a $2,000 phone when we've got constricting household budgets? So that whilst they're sort of those, normally in a bit of a bull market, those announcements should be really bullish. But Google's AI project so far has been a disaster. You just seem to have to drop the buzzword at the moment, and you seem to get a bit of an uplift. But you got to remember, all of those mega cap companies are massively cyclical. So they've just got big cash balances and a bit buffered for now.
Although Druckenmiller, the man, did say that he thought Nvidia and Microsoft would definitely weather the storm. But then when you look at his notifications, whatever it is, the Section 12 or whatever, he had been buying them. So maybe he was chatting his own book.
And I'm happy to own them long term, don't get me wrong, but there's such a concentration risk. If they drop 10%, the index probably falls 5 to 7.
Totally.
So, and that's a big drop, and the rest of the market's not performing that well, and it's probably not going to take it very well. So, it's just more something to be wary of, rather than underneath those mega caps hiding. Those mega caps are hiding the sort of underlying poor performance of the stock market.
Totally.
On that note, Mark Garner, Macro Capital. Appreciate your time. Okay, let's get across the leaders and laggards. Starting with the leaders, of course, and drum roll please, what have we got? Life 360 extending its run from yesterday.
Yes,
of course.
continuing to do well. People clearly like the story. Tracking family members, tracking pets, tracking phones, tracking whatever you can attach a tile to.
Yeah, unfortunately, we should have brought that one up with Mark, because I'm sure he would get good use out of that that app. Just probably simply counting family members in that household. I would dare say. Okay, Lake Resources also up 4.9%. That's extending a little bit of a run too over the last few days. Not necessarily, I don't think, any news that we could find, but it's just, I guess, momentum with these highly specky lithium plays. Domain also higher, 2.43%. Yeah. We just mentioned Xero, and that's good to know, because you said that. Did we confirm that there's reporting tomorrow?
That's my understanding.
Yeah.
I think they are reporting tomorrow. I can just check on that one. But
if you're a Xero shareholder, check that one. We can confirm whether that's the case or not. But obviously, if there's a high quality tech company on the ASX, you'd have to say Xero is probably it. So a few people might be interested.
Earnings report tomorrow. So
cool.
Also Aristocrat is also reporting, New Farm, and then we've got a few AGMs going on as well. So it continues to be a time of company updates, really.
Certainly does. So let's look at the laggards now. And right off the top, we've spoken a lot about Incitec Pivot. So that's the cranky sell for some. You can see there, obviously, a few other investors have got the same opinion, down 8.3% almost for the day today. Core lithium, you've got to have lithium names either on the top or the bottom of the market map, right? But we just seem to be moving between one or the other, depending on how much leverage you can access and what sort of momentum is flashing on the charts. Samphire Resources, another one that I don't think we've actually had any news on necessarily, but another thing to keep note of, just as a bit of a mover and shaker. Coronado Global Resources actually had a really good conversation today with Carl Capolingo. He loves his charts. He spoke exclusively about energy today, and we were digging into the coal space a little bit as well, and just maybe some of the ominous signals there from a macro and technical, or fundamental and technical point of view. Yeah, he just sort of looks at the price action to start with, but I didn't actually fully appreciate the kind of collapse that we have seen in like natural gas prices and coal prices.
Natural gas has absolutely tanked. And people, forget about that one. No one's talking about it, I guess, because in Australia, us consumers haven't seen the benefit of what the international price is doing. But that's a nice politically charged conversation for another time.
Yes, with a wine in hand perhaps, or something like that. We'll rehash the old political ambitions or something of that nature. But Elders as well. We spoke that's the follow through their effect from some poor results. And here are the leaders as far as the small caps go. Serco, actually Temple & Webster I think was actually out with some news today.
Correct. I think they had their results, which were obviously better than expected, but they did use the term AI, just to flag. That was in their offering. They are going to increasingly use AI, but having renovated, I must say the Temple & Webster website did come in handy.
I didn't like did I tell you my Temple & Webster story?
No, but maybe another day.
I was missing a couple of pieces of a couch, and rather than send me just those pieces, they sent me an extra couch. And I couldn't get through to their customer service team because it was all automated, and they said keep the couch. So we kept the couch. I sold it. It was great. Had a free couch. Okay. Anyway, laggards now quickly on the small caps. There you go. I'll let you peruse that yourself. But okay. Shifting on, just quickly look at what's going on overnight as well, because there are some major stories. Eurozone CPI, we're still expecting, more or less, most are expecting that the ECB will continue to raise rates from here. And Cisco and Target, a tech name, and
housing starts in the US.
Oh.
Yeah, they've been very, very sluggish. They're not building enough either.
Yeah.
So,
Okay.
But affordability is absolutely, dreadful in the US, and that's why nobody is bothering to refinance their loans, because you go from 1% to 6-7%. Why would you? Not till rate cuts, I guess, and we'll get a whole new swathe of home buyers coming in. But let's get to the news tomorrow, because we do have the labour market figures. We already spoke about Aristocrat, Xero, of course, there we go, New Farm as well. Yep. Those jobs numbers expected to show the unemployment rate remained steady last month at 3.5%, about 24,000 jobs expected to be added to the economy. So, we'll see how that goes. Of course, will be important for RBA considerations. And the ASX 200 looks like it closed down about 35 points, almost 0.5%. And so profit taking.
That's it.
For me.
We always have so much fun. We run over time, but well,
Exactly.
I'm hoping that you enjoyed as much as we do. For now, we'll say goodbye. Remember, you can catch up on all the views and interviews on our website now. We look forward to seeing you tomorrow morning.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.